Hello and welcome to Cafe Mutual YouTube channel. Friends, the last financial year has been tremendous for equity funds. In fact, over the last 1 year, the key benchmarks like Sensex and Nifty 50 delivered over 19% returns. The question that every investors want to know is whether this rally continue or correction is around the corner. To answer this critical question today, we have with us Mr. Shailesh Raj Bhan, Deputy CIO Equity, Nippon India Mutual Fund. Shailesh has over 24 years of experience in equity market and research. His funds have been consistently creating wealth for investors. Welcome, Shailesh.
Thank you. Thank you, Nish, for having me.
So, Shailesh, my first question to you is that equity market have been at all-time high again. In such a scenario, what should mutual fund distributors recommend their clients? Should they recommend lump sum in equity funds or staggered way is more preferable?
Given the way the markets have rallied in the last years, right? Directionally, I think obviously they are not very, very cheap from a valuation point of view. So I think the best way to approach markets today, given the general headwinds which are there on the international front and general rise in commodity costs and all that, a staggered approach to investing is a much better approach for the next few months point of view, maybe next few quarters point of view. And if you have disruptions in markets which give you an opportunity to participate at better prices, I think then we can use a lump sum option. The most critical question here, in addition to being investing in a staggered manner in lump sum, is the time frame which you need to have in mind. I think anybody looking at equities generally keeps a medium-term time frame in mind, and at least a 3 to 5 year kind of an investment horizon is also a very critical factor in addition to how you invest your capital today.
Okay, but which category of equity funds should they recommend to their clients?
Primarily, diversified equity funds are the best way to go, and within that, I think where the current construct of the market stands, which you have some macro headwinds and all that, the large cap space appears to be well positioned. Significant foreign investor selling in the last few months has made this category relatively more attractive because valuations here have remained reasonable, and the general conditions for the large businesses who are gaining market share, whose profitability is improving, and who have better and strong balance sheets to fight any of the challenges like cost inflation and things like that. I think these are the best positioned businesses with the large cap space. So this is one category, the large cap side, which looks very interesting from a valuation point of view, as well as a risk reward point of view from a medium term horizon investment.
Okay, so Shailesh, talking about the markets, so what is your medium term outlook on the equity markets, and what are the key triggers and risks for the markets from here?
Primarily, when you look at markets from a fundamental point of view, there are many factors which India is seen the challenges of the past and is now entering in terms of many positive factors. Like, for example, you have tax collections improving, you have business growth recovering from lows, you have large sectors like real estate, power, IT services all firing positively. So when you see it in the context, all the pain and challenges of reform has been taken already, and you are now possibly recovering from a growth point of view. Even your exports are booming today. And when you put all this in context and on that overlay a China plus one, on that overlay the Make in India program, you will find that there are many investment growth triggers from India from a 3-5 year horizon. I very well understand that you may have near-term challenges of high inflation and costs, but the good part is that our markets and the economy is slightly more insulated than it was in terms of how it was, say, a few years back, maybe 5 years or 10 years back, because of the strong forex reserves and the other advantages which we carry today. Another interesting aspect of the market, which one should look at, is our base of earnings, except for the recovery of the last 12 months, has been very low for nearly 7-8 years. Many sectors which have massively underperformed then are just starting their earnings story, so which is primarily on the investment side of it. So today we have a full investment cycle in front of us. Today we have a recovery in many sectors which suffered because of COVID, the opening up trade as people call it, or the services sector coming back. And generally, even exports which have been suffering for nearly 7-8 years have actually started to come back strongly. So you have a combination of all the things working together. And fundamentally, the positioning is there that you can have India's earnings doing well from a 3 to 5 year horizon. So these are, in that sense, directionally reasonable times to participate in equities. From a risk and challenges point of view, I think we have already come off of a very low base of market, so valuations are not very, very cheap, right? So that is one important aspect of the markets which they have to keep in at the back of their mind. The second important point is that internationally and locally there is pressure of inflation, pressure of interest rates rising, at least in the international markets, is fairly significant. And this can be an important driver for equity market valuations in the next few months and maybe next 1 to 3 years as well. So our expectation from the market is that we would expect earning-led return rather than a multiple re-rating of the markets, which is one point. So our expectation should actually be moderate given where the circumstances are of macro conditions and where the valuations today stand. Lastly, I will not comment so much on the geopolitical challenges which we see today because I think they can be transient and they may go away. But we'll have to be watchful that the inflation which we are suffering through the economy and the world is going through, if it lasts significantly longer and very drastic steps have to be taken to contain them, that is one risk factor which you have to keep it at the top of your mind. If you remember, oil is already above $100 and continues to remain there for some time. So these factors do matter from a medium term, from a shorter term point of view to from a risk point of view for the markets.
Yeah. So Shailesh, today RBI has estimated India's growth to be above 7%, right? And considering the inflation of 5% maybe, so can investors expect over 10% returns from large cap funds going forward?
I would want to emphasize on how we are approaching the markets, which will give you some background to the kind of return expectations investors can have. Our case is the earning growth opportunity in India is still ahead of us. Like, after a recovery in the last 12, 18 months, we still have a long way to go. And profit to GDP and growth in earnings in India is ahead of us in the next 3 to 5 years. And in that horizon and in that time frame, I think market generally would respect the earning recovery and earning-led returns can be expected. We don't see major PE multiple-led returns coming from very, very quickly, but earning-led returns are possible for investors over the next 1 to 3 years or 1 to 5 years. That's the kind of a horizon where we see earnings expanding, which actually can benefit investors and large cap companies.
So earlier, so Shailesh, you have earlier mentioned that large cap looks attractive from risk reward point of view, right? But how comfortable are you with the valuations of large cap companies currently?
Within the available universe which you have, the large, mid, and small cap companies, the valuations of large cap companies are reasonably normalized in the sense they are not more expensive than mid caps or small caps, so they are reasonably normalized. Second is the earning recovery in large caps is very good. It's very, very strong. In fact, any negative news flow which comes like commodity pressures and all that, the large cap companies are able to manage those margins better, have better control, better processes, and better management of cost possible there. Also, we have seen all these companies have gaining market share and gaining profitability versus the unorganized and mid-sized competition, because it has become challenging for smaller and mid-sized business to really demonstrate or compete with the larger companies in the space. So we are finding greater profit share gains for larger companies. We are finding their valuation generally obviously higher than what they were in the last 2 years, but I think reflecting earning growth in the system. And lastly, the stability and solidity of the earnings of the large cap space appears to be far more robust. So I think when you put this in the context, I think from a medium term kind of an horizon, I think this is a very interesting and exciting space to be.
Okay. So Shailesh, over the last 1 year, Nippon India Large Cap Fund has performed exceptionally well. However, 5-7 year performance of the fund is at par with the benchmark. So what are the 3 things that have helped the fund regain its momentum?
Interestingly, if you recollect 2 years back or 3 years back, markets were extremely narrow. Only a small segment of the market was delivering returns. Okay. And valuations of those sectors had gone way off. Our emphasis, even in those markets, was buying companies with sustainable, profitable growth, not overpaying for growth, which was kind of a phenomenon. I know people were talking about this as growth investing and all that. It was just that you were overpaying for growth. And so we have avoided those spaces very significantly in the last 3 to 5 years. Initially, it didn't help us so much, but in the last 2 or 3 years has given us tremendous advantages versus where the market construct stands. So when narrow markets started to get broad-based, when you bought companies at right and reasonable valuations, and these were high quality businesses, just out of favor companies, they have given tremendous recovery from in terms of their valuations, and they have given tremendous recovery even in their earnings today. The principles which have worked for our large cap strategy has been our ability to focus on high conviction ideas and staying invested through them in difficult times. We have also not overpaid for growth. We have seen market going through a lot of growth investing hype where people were or businesses being valued very, very highly and expensively, and I think they have suffered significantly in the derating which has happened. So our focus on not overpaying for growth and high conviction investing has allowed us to capture returns in a market which underwent a major shift. The broad basing of earnings is also a very positive factor which has supported the fund returns, because the broad basing of market allowed us to capture returns on a much broader scale on across a large number of sectors. So the shift from narrow markets to the broadening of the markets has been captured well by the fund, and our focus on sustainable profitable growth at reasonable prices as a strategy has worked. And we think the markets are ripe today where earnings are expanding to allow this strategy to do well over the medium term as well.
Okay. So Shailesh, close to 50% of the total exposure of the fund is in financials and technology sectors. So what are the reasons for this?
Both financials and technology are a large component of the fund. And if you look at it, even from a profit pool point of view, financials and technology are among the top 2 or 3 sectors in terms of the profit which the whole country earns, out of the listed space. These are the top 2 sectors which have in terms of the size of profits as well. Also, interestingly, let us take the banking sector, for example. It's a very simple sector at one construct point of view. And India has seen some of the worst crises in the last 10 years, right? Whether it is the corporate NPA cycle, whether it is the NBFC crisis, and so many such problems. The banking sector has weathered all of this, has suffered a bit on growth, has taken write-offs, and has now come out very, very strong despite a COVID crisis. They've actually managed to grow their profits and manage their credit cost very well in this environment. Also, the valuations of this sector remain very reasonable in the context of where the broader market stand, and the whole investment growth, credit growth opportunity for this particular space still remains to be captured. So the next 3 to 5 years, when we talk about a big investment cycle in India, it cannot happen without these banks becoming the key providers of capital for growth. I think we've got them at reasonable valuations, and the whole earning growth opportunity for this is yet to unfold. And their balance sheets are the strongest ever in the last decade, I guess. As per our understanding, it's very, very well. On the technology side, again, this sector, after many years of consolidation, has seen a solid recovery in growth supported by COVID. Because when COVID came, people preponed their digital spends significantly, especially in the US and European markets. And I think that has seen a huge demand for our IT services companies. This, I think, is what our companies are best at capitalizing on. And I think this shift to digitization seems to be a medium-term journey. It does not seem to be a 1 quarter, 2 quarter, 3 quarter phenomena. It will be a medium-term journey. So when you look at this from a medium-term point of view, our IT services businesses are well positioned to deliver growth. And their growth recovery seems to have a longer runway than was earlier envisaged. So these are the primary reasons why we have significant investments in financial services, banks, and the technology companies.
Great. So one final question, Shailesh. Why do you think that MFDs should recommend Nippon India large cap funds?
See, primarily, the fund has a long history. It's built a track record over a long period of time. And more importantly, it has consistently followed the philosophy which it has said. It's about buying companies with a sustainable, profitable growth outlook at a reasonable valuation. So the fund has never swayed away from that by doing any fashion investing or any momentum investing. It's actually generally focused on quality at reasonable prices, growth at reasonable prices across cycles. So it's close to a decade and a half kind of investment history for the product. And we have seen that we have maintained the same style and approach so that the investors get the right kind of return experience from the large cap space. Second is our investment also comes from a point of view that there is a focus on a few large outperforming opportunities which you keep getting once every 3 years. So our emphasis on, say, the engineering and infra space, when the whole world was only looking at the consumer side, I think is a great opportunity which the fund has created, a fund has got into. And I think that segment of the market is very well positioned to deliver over the next 3 to 5 years. So that also, any shift and growth in those segments benefits our fund because our investments are oriented towards that. So this is the way we have constructed it, and it is very different from what the normal index would look like because of the active share and the positioning we have taken. And as earnings growth of the portfolio improve over the next few quarters and years, I think that benefit will be visible to the investors in the fund. So the approach and the philosophy is to create a product based on high conviction investing, sustainable profitable growth, and growth at reasonable prices, and try to capture what's happening in the large Indian companies in India. So these are the reasons which the product tries to work on at all points of time to keep the product relevant to our investors.
So with that, we have come to an end to this interesting session. Thank you so much, Shailesh, for your valuable time and insights. I hope our audience will be hugely benefited by your wisdom.
Thank you so much.
And finally, I thank each one of you for being such a wonderful audience. Keep watching Cafe Mutual YouTube channel. Have a great day at work, friends.